This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HCJ.tax.
Good evening and good morning or good day if you're in the US. Thank you for joining us. Today on HCJ.tax, every week we do live streams on tax-related topics. And this evening we are honored to have with us Damien Malone, who is going to lead us on a presentation on Ireland taxes, and then we'll jump into the questions that you sent us. So we do have that Q&A afterwards. Just to remind you that this is being live streamed and it is being recorded. So if you're joining us on Zoom and you do not want your image to be captured, just keep your camera switched off. For those, and I'm going to mute. All right, I'm also going to mute you. So please keep your mic on mute. If you want to ask a question, regardless of which platform you're looking at us on, feel free to type in the box below and we will handle the questions or comments in the order in which we receive them. Of course, I'm legally obligated to say that nothing we say here should be construed as advice. We are not giving you information and you're going to run off and do whatever we say, right? We're having a general conversation about general principles. You can treat it as education or you can treat it as entertainment. Now, when you're ready to make decisions that are about your business or your personal tax situation, you need to retain someone who will know your situation inside out and can advise you accordingly. So again, we are not giving tax advice. So without further ado, I introduce you to Damien. Damien, over to you. You're on
Hi guys.
Right, yeah.
Hope everyone can hear me okay, and I hope my internet stays good. We had a little mini crisis before we came on. We have a storm in my part of the world in Ireland, and my internet was down. So hopefully it stays going and all that. If it drops off, I'll have to reconnect on my phone. So I'm just going to share my screen with you all just to get my slides up, and we'll get into my piece. Hope you can all see my screen there now. So I'm Damien Malone. I'm the founder of Malone & Co. We'd be, by Dublin standards, considered a mid-size accountancy and tax practice. We're based on the west side of Dublin. And we have, as of now, I think we have 28 staff, soon to be 30 in the new year. And that's a mix between the different disciplines that we service, between general accounting, audit, tax, corporate services, and company secretarial. So the title of our chat this evening, US expat taxes in Ireland, guys. And what I'm going to do is I'm going to give you a quick rundown of what the taxes in Ireland actually are to begin with. And I suppose then how they impact somebody coming to live in Ireland for the first time that's not an Irish national. So our first tax is income tax, and this is really tax on people's on the income that they earn and any, I suppose, investments that they generate. So in Ireland, it's called income tax, but really we have three different, I suppose, strands of direct taxes on people's income. So the first is PAY, which is pay as you earn. The second is Universal Social Charge, USC, which was introduced in our recessionary years when things were not so good on the economic front. And the third is PRSI, which is pay-related social insurance. So each of the three are taxed completely independently to the other, and they all have their own, I suppose, their own calculation to be done. And I suppose we'll come to that a little bit later. Obviously, if you're a self-employed person or if you're an employee, there's a different process as to how income tax is calculated and collected on your pay. Corporation tax, which has been a big money spinner in recent times for the Irish Exchequer, with the amount of, I suppose, international business and international people that want to set up their business and investment interests to Ireland, and our headline rate for that is obviously the 12.5% rate, and that's generally covers all forms of trading income. There's different tax rates then obviously for corporation tax for passive or investment income as well, which we can touch on a bit later. Capital gains tax is where we is the tax in Ireland that's triggered when one sells or disposes of a asset at a gain, of course, and the headline rate for that is 33% on profits made from from such gains. There are quite a few exemptions to that, and I suppose variants of it as well for business people, and we'll get to that later as well. Capital acquisitions tax, this is essentially gift and inheritance tax. So if you come into a gift or if you are in receipt of inheritance, this tax is what applies to that, and the rate of that, similar to capital gains tax, is 33%. Again, with different calculations and different, I suppose, levels at which the tax applies depending on a variety of circumstances. Value-added tax, VAT. So for anyone living in America, who they may not have experienced this before, but this is a tax that's generally levied on consumers on everyday goods and services that's there. And again, if someone was coming to Ireland to set up a business in Ireland for the first time, some background noise there, guys. Hopefully it's cleared up there now. If somebody was coming to Ireland to set up a business for the first time, you actually, when you take on or assume the role as a business owner, more often than not, you will be obliged to collect VAT on behalf of the Irish government, and or if it's in any EU jurisdiction, you become the VAT collector when you're in business. Stamp duty is a tax on legal documents, such as if you come over to buy a house, you would pay stamp duty. You would pay stamp duty on purchasing your house, and that's essentially what that is. And we then, a couple of years ago, we introduced local property tax, and that's a tax on property ownership, essentially. And depending on where your property is located and the value of your property, that determines the level you pay, and it's an annual charge. So there's the taxes that we encounter on a periodic basis in Ireland, on an annual basis as we go along. So what determines the charge to tax in Ireland? So obviously it's based on a couple of these concepts that we have in tax, and first one being residence. And really, to be classed as tax resident in Ireland, you have to be here for 183 days or more in a calendar year, or between 280 days between 2 years. So if you're not in Ireland in 2021 for 183 days or more, but you are in Ireland between 2020 and 2021 for 280 days or more, you could still be classed as a resident in Ireland, and therefore that's when residence tax kicks in. Again, where we have cases where an individual could have could satisfy the residence criteria of 2 jurisdictions or potentially more, what they tend to look at various factors, such as, where's the person's, I suppose, center of vital and economic interests, and where they would have a permanent home available to them. So for anybody sort of floating around a place that is concerned about this, happy to hear, I suppose, and give our thoughts on that if they're maybe considering either coming to Ireland, or they're spending a lot of time in Ireland and don't want to trigger a tax residency scenario where the Irish state will have a claim on their income or gains. We have this other concept then called ordinarily resident, and this is where an individual is resident in Ireland for 3 consecutive years. So if you're resident here for 3 years, you automatically become ordinarily resident, and it takes 3 years to lose your ordinarily resident status. The final concept, and what's very important in Ireland, and what very advantageous for overseas people coming to live and work in Ireland for the first time, is the concept of domicile. And this domicile is generally, everybody has a domicile. It's generally where you were born, or where your father was born. You generally assume that country as your country of domicile, and it is a difficult thing to change. So if it's a case you see, or you choose that you don't want to be considered domicile of a particular country for whatever reason, you have to have a very compelling reason. There must be a lot of, I suppose, compelling evidence to indicate that is your true position with that. So the domicile piece leads into our next slide, which is on foreign income taxation in Ireland, and really disadvantageous arrangement that we have for overseas individuals that we call the remittance basis of tax here. And this works by, if you come and live and work in Ireland, but you're not an Irish national, you're not of Irish domicile, you only pay tax in Ireland on the money that you remit into Ireland. And that's a very powerful relief that, once it's utilized correctly and managed accordingly, gives people a very good opportunity of accumulating significant wealth outside of the state while enjoying all the benefits of living and working in Ireland, and even availing of the Irish tax reliefs that are there on Irish source income on that. So that applies to income, and it applies to most gains as well, from a capital gains perspective, where you're only liable to gains that you remit into Ireland with that. And of course, as well, it generally only applies if you have value and wealth generated prior to arriving in Ireland. You can generally bring that into Ireland without triggering the tax in Ireland on that. And I suppose there's a distinction that you would generally like to, I suppose, see a client make between income and capital funds that they would have. The income being the annual periodic income they generate for their livelihood, and their income or their capital funds then being essentially their accumulated wealth. And it should be clearly able to distinguish like for like in a case where a person is non-domiciled in Ireland but is residing here and availing of the remittance basis of taxation. Final point then, just from a capital acquisitions tax point of view, and if you're going to be residing in Ireland for capital acquisitions tax to trigger, you have to be resident for 5 consecutive years here to fall within the charge to tax of that, or it must consist of the inheritance that you would make must consist of Irish situated property, or the person giving you the deceased person that you're going to take the inheritance from must have been resident or ordinarily resident here at the date of death. So again, in most cases, most inheritances for people that have been in Ireland within 5 years wouldn't be caught within the charge to capital acquisitions tax here. So just to talk a little bit about the filing regime in Ireland and what that entails for someone who comes and lives and works in Ireland. So obviously for income tax, people who are business owners or people who are employed but would have other investment sources of income have to file an annual tax return, and it's called a Form 11. In some cases, it's actually called a Form 12, which is just a shortened version of that. But that's what the annual tax declaration form is. It's 20-something pages to complete, and it's quite a daunting exercise for someone who has never saw one before. So generally, the return is due by the end of October for each preceding calendar year. So up to about 4 or 5 weeks ago, my office would have been extremely busy completing all our clients' income tax returns for the 2020 year. So you have till the end of October in the year after to file and pay your tax. So you actually do get quite a bit of leeway when it comes to actually settling up your affairs, which is sometime after the actual income can be earned and generated. From a corporation tax perspective, so again, this would be a scenario where someone comes to Ireland and decides to set up a company to run their business interest through. You generally pay your corporation tax once a year, and that's generally on the 23rd day of the 9th month after the financial period end. We do have a preliminary tax regime in Ireland, guys, and really how this works is after your first year in either the income tax or corporation tax system, you are supposed to make a preliminary tax payment for that year. So it's a way of getting a down payment in respect of the current year. And there's a different rule for income tax and for corporation tax, but just to take note of that, that is a requirement after year one. For people who establish and set up a business in Ireland, they will have to register for VAT, most likely, if the services that they are providing are vatable, and if the services are in excess of the registration thresholds, which are quite low. VAT returns are either submitted on a bi-monthly basis, a 4-monthly, 6-monthly, or you can apply to have them on an annual basis. And what determines your filing period is the level of liability that you have for them. Payroll returns. So if you set up a business and you employ staff, you have to register as an employer and you have to operate a payroll. We had big change with this over the last 2 years or so with the introduction of what was called PAY Modernization, which really brings operating payroll into real-time reporting. So every time we do a payroll submission for a client, whether it be weekly or monthly, the figures get communicated to the tax office at that period. It used to be the case that was only once a year, and we'd file what the actual staff numbers and staff figures and tax declarations and so forth were. That has changed, and really that's the way tax is going in tax and VAT and all the main tax heads is going now, where is real-time reporting of all taxes. We do have a somewhat penal regime in Ireland if you get into difficulty and are delinquent in your tax affairs over here. So if you file late, you can be surcharged on your tax liability. If you delay by anything more than a short period of time, they can charge you interest. They can charge you fixed penalties that are a predetermined amount based on the actual return that you didn't file. And if you're unfortunate enough to fall foul and come under scrutiny from an audit perspective, if they audit you and they get a settlement from you for more than 30,000, your name does get published periodically. Every couple of months they publish the defaulters list, as we call it, in the local media in Ireland. So just to be aware of that as well. I have a slide on the social security system in Ireland, and I would have touched on PRSI as being a component of the overall income tax charge in Ireland that we pay through our payroll when we're employees or directors, or that we pay at the end of the year through the income tax system if we're self-employed. There's generally two components to this if you're on a payroll working for a business, or if you're an employer and employing staff. So we have what we call employee PRSI and employer PRSI. The employee PRSI is a deduction leveled on the employee themselves, and there's differing rates of that, but the general rate is 4%. If you take on a staff in Ireland, you do have to pay employer PRSI. At this moment in time, we have two rates of that employer PRSI, the high and most common rate being just over 11%. And I think now the lower rate is just nearly 9%. So it's quite a significant extra cost to employing staff in Ireland. And unfortunately, it's only going one way, because it's due to go up again. It's due to go up again in the years ahead. And separate to that as well, in Ireland, we are introducing auto enrollment into pension schemes for employees, which we haven't had before. So if you're an employer, you have to make a contribution to your employees, private pension. And then also we're bringing in mandatory sick pay. So in Ireland, a lot of, I suppose, smaller employers wouldn't have a sick pay policy for their employees, and the employees would have to depend on the state for that. It's going to become mandatory. So we estimate that in 2025, which is just over 3 years away, aside from inflation and everything else, the cost of employing staff is going to increase by about 16 to 18% to take account of all of this. So anybody thinking of setting up a business in Ireland that will employ staff should be mindful of that. So this PRSI, what this does, this goes into a fund that funds the different benefits that the Irish that the Irish state pay out. And we've different classes of this PRSI, the social insurance, depending on your circumstances and depending on the nature of your work and your employment. The two main classes that I'm going to touch on, one is the most common class, which is Class A, and this generally applies to all employees that aren't business owners, essentially. The Class S, the Class S side of it then is for essentially self-employed people and company directors that would have a controlling interest in their business. So this entitles, obviously, the main benefits are if you're out of work, you get job seekers benefit. It qualifies you for the state pension in Ireland, which is quite advantageous, about €270 a week once you meet a certain number of contributions over the years for this. You qualify for an Irish state pension, which is a relatively valuable thing. They've increased the claiming age of it. It's now 66, and they're trying to bring it up to 68. But if you live till you're 100, it's not a bad return for someone who may come and live and work in Ireland for a period of their lives. The self-employed people, basically the differences between what they get and what the employed persons would get, they don't qualify as things stand for illness benefit, for carers benefit, for health and safety benefit, or for occupation and injuries benefit. And these are a range of benefits that's there under the social insurance provision and fund in Ireland, that all of this PRSI goes into. That's levied on income tax, levied on profits and levied on wages in Ireland. So my final slide is just some general points that just to talk through and give my thoughts on, and just to make you aware if you're not already aware, and it impacts any of you that are listening in. So the first is the SARP relief. So this is the Special Assignee Relief Program relief. This came in some years ago, and the purpose of this relief is to, for Irish incorporated businesses to be able to attract the type of talent that they need at the, I suppose, the upper managerial levels, because we do have quite a high income tax regime in Ireland, and it kicks in at an early stage. So if you're a single person over 35,000, you're going to be paying close to 50% of your income over 35,000 on the personal taxes in Ireland. So this relief has the effect of for higher paid executives who come and work in Ireland, a portion of their income above 75,000 is exempt from income tax, and the 75,000 beginning point goes up to $500,000. So for, as I say, highly paid executives, it's one measure that's there that can I suppose make Ireland some bit competitive in a very competitive global space for top talent and for top executives. We have a 3-year corporation tax exemption, which is beneficial, or can be very beneficial, for entrepreneurial people that have an idea and they want to come and live and work in Ireland and set a business up here with that. And basically, if you set a business up in Ireland and pay staff or employ staff and pay social insurance on behalf of those staff that you employ, you can get a credit for that social insurance against your corporation tax bill. So you can earn close to €1 million in your first 3 years in taxable profits. You may not have to pay any corporation tax on that if you are employing staff. So again, quite a useful measure that's there for someone that has a business idea and that that is prepared to come or bring a level of investment into Ireland to get it off the ground. We have what's called benefit in kind in Ireland, and BIK. So this is a tax on benefits that if you're a business owner and you have a company arrangement, you can't really use your company cash, your company profits to pay for benefits on your behalf. So obviously the likes of accommodation, vehicles, that sort of thing. We've a tax measure that's there to counter the effect of that, where essentially they tax you on the notional value of the benefits that you receive. Again, we do have some exemptions to that we would recommend, and most of our clients avail of those exemptions that's there. One of the bigger ones being on the vehicle side of things. You can actually drive an electric vehicle in Ireland. There's no benefit in kind tax on that at all. once you don't go above a car of a certain value. So that's quite advantageous for a business owner. And then we've a sequence of sort of smaller benefit in kind measures that this time of the year coming up to Christmas, we can give our staff and we can give ourselves a €500 voucher, and there's no tax implication on that. But important to note that if you are involved in the business, or if you are going to come over to take employment here and you have a package in front of you that has perks on it, the likes of health insurance and that type of thing, that there is this extra tax implication called benefit in kind that will impact on your net take home pay from your overall package. An area that we would do a lot of with our clients is on the pension side of things, and we do have I suppose the most significant tax breaks, or at least some of the most significant tax breaks that's in the Irish system for business people and for highly paid employees are on the pension contribution side of things, particularly for business owners who would set up as a limited company and they become director shareholders by utilizing the measures that's there under executive pension schemes in Ireland, where they can extract a very, very significant level of their business annual profits into a pension scheme that they can then in turn accumulate value and wealth through, with the objective of self-directing it down the road. Would be a common approach that most of our I suppose successful business owners would adopt with that. And as I say, very tax efficient, because you get tax breaks if you pay the pension contributions yourself. You do get a break from the income tax, subject to certain levels on that. And even more so in a company structure, the company can fund quite excessive levels of contribution depending on the level of pension provisioning and your salary and your age and some factors like that. For business owners as well in Ireland, we do have a number of measures that are there to give relief for people who are successful in business and successful in life, that they can avail of these reliefs on the sale of a business. So the first one is what we call entrepreneur's relief, and this has the effect of, if you set up a business and sell it, you only have to pay 10% capital gains tax on the first €1 million of proceeds of that sale. Again, subject to a number of conditions and T's and C's and so forth, but a useful enough relief to have. There's no age limit at that, and so anybody who sets up a business, once you've worked in the business for generally 3 years, you can avail of this entrepreneur's relief if it's a sellable business. Retirement relief is for Irish business owners who come to your retirement stage, and basically not too dissimilar to entrepreneurial relief, although there are some differences in the conditions. You can sell a business or you can retire from a business, and you can get up to 750,000 without paying any tax whatsoever on that. The retirement age is typically 55 for that. For, I suppose, businesses and for business owners that would have aspirations of transacting in the millions as opposed to thousands, an Irish holding company can be a very useful vehicle and a very useful structure for wealthy entrepreneurial people. And the main advantage of an Irish holding company structure is that you can sell your subsidiary investment interests in businesses, and there's no tax whatsoever at Irish holding company level. And again, we would do a lot of work around that, like where we come across clients who have very strong trading companies likely to be sold at some point in the future, and early planning with getting an Irish holding company in place so that they can sell their or plan, have the plan in place to sell their company in the years to come without incurring a tax charge. Can also give a vehicle for extracting surplus profits out of a good, strong trading company where the owners and the shareholders want to reinvest those profits into something else separate to the trade of the company. So there are that concludes my slides, guys. And that gives you an overview of I suppose the tax regime in Ireland, and specifically the tax regime from I suppose a business owner perspective, or for someone coming to take up employment in Ireland. So happy to go through with Darren any of the queries that came in, and we'll give you our thoughts on it.
Right, fantastic. Thank you, Damien, for that comprehensive overview as usual. We have been getting your questions, which we've added to the queue. So normally, previously, I would have gone through stuff on the US side, but I think that's a bit redundant. So what I will do, as we've been doing for the past 2 or 3 installments of this, is just jumping into the Q&A part of it. So the first question that was submitted is, how is crypto treated in Ireland versus the US? So I'll just talk about it from the US perspective first, really quickly. So there are well, first of all, in 2014, the IRS issued, I think it was notice 2014-21. And then in 2019, there was an official revenue ruling. I think that was 2019-24. So basically, it's treated as property. So it's not recognized as a security or whatever. So what I'm assuming now that you are looking at it as an investor. If it is your trader, the stuff that I'm saying may not apply. So I'm assuming that you're an investor, right? So if you're an investor, the list of, let's say, taxable events has been expanded as a result of that revenue ruling in 2019. So everyone knew, obviously, when you convert crypto to fiat, that will be seen as a taxable event, right? But right now, as a result of the expanded rulings that we have, if it is that you are trading one crypto for another crypto, taxable. Spending crypto to purchase goods or services may be taxable, or earning crypto as income, that may be taxable as well. So the definition is pretty wide. And then in terms of how the crypto is valued for short or long-term capital gains, you are able, I mean, previously people would, on the side of caution, and everyone was using FIFO, first in, first out, but the rules allow us to use FIFO, first in, first out, LIFO, last in, first out, as well as HIFO, highest in, first out. So there's some level of flexibility. But again, I'm talking about investors, not traders. Traders is a whole different ballgame. And that's it from the US perspective. Damien?
Yeah, very similar, I think, Darren. So it would be a chargeable event for a capital gains tax transaction, selling crypto or trading one crypto for another. In Ireland, we would be, I would have thought it would be on the FIFO method as well with that.
Okay, gotcha. And moving on to the second question again about crypto. What about tax planning strategies for crypto investors? From a US perspective, especially now that we're coming to the end of a calendar/tax year, I think loss harvesting is probably the most popular method, where you are able to offset losses against gains. So if it is that you have any losses that are not yet realized, so whatever coin that you've invested in may have gone down in value, and you may be holding it against some that may have gone up in value, and you do want to cash out and do something with it or whatever. Just remember that you're able to offset one against the other. And the wash sale rules that apply to securities do not yet apply to crypto. So you can maintain a position. So you can book a loss, and then in X number of days or weeks, early on in the new year, you can reacquire that token, and the wash sale rules don't apply. So you can enjoy that loss harvesting strategy. In terms of longer term strategies, we are referring people to an attorney that we work with to talk about opportunity zone funds, so opportunity funds, but bear in mind that there's a lockup period and it can be quite complex, but it is an option available. And of course, Puerto Rico. But if you're in Ireland, then Puerto Rico doesn't come in. But with the US, the thing is, with the US passport, you will be subject to US taxes regardless of where you go. The only jurisdiction that you can still maintain a US passport or green card, and enjoy lower capital gains, generally speaking, as if you move to Puerto Rico. I know, and I know you didn't ask this, but people frequently contact me and ask whether just finding an offshore company somehow allows you to mitigate any taxes from a crypto perspective. The answer is generally no. There's no way in which you can just form a company and that somehow magically allows you to mitigate your capital gains taxes from a US perspective. So just to summarize, from a US perspective, you can look at loss harvesting. You can look at opportunity zone funds if that's something that matches your investment appetite. And if you're willing to leave Ireland, there's Puerto Rico. Damien?
Yeah, so you call it loss harvesting, loss crystallization is how I'd call it. So if there's an opportunity there to crystallize any losses there to shelter it, yeah, depending on the level of holding that you have, we've came across some people in Ireland who have actually left and who have commenced a process of residence planning to get out of being resident here. That's really the way where it's at. If you want, there's no other real way of avoiding it. Obviously, Portugal, Malta would be two of the jurisdictions that we see some of the big crypto players exiting from here in our experience as well, and that's what we've came across.
Okay, fantastic. Thank you for that, Damien. Next question. So a 1099 contractor. Okay, so just to put it in plain terms so everyone can understand what I believe this person is asking. Please correct me if I'm misrepresenting your situation, right? I just want to summarize it real quick. So you are an independent contractor, you're self-employed. You're self-employed and you have moved from the US to Ireland, where you intend to continue to be self-employed as you were. Your clients are in the US. So the question is, what about social charges in Ireland? At what point does that become a concern for an independent contractor based in Ireland? Damien?
Yeah, so I think with that, first of all, if you're an independent contractor and doing more than, let's say, 40K a year, I would probably be saying you should be a limited company in Ireland. But failing that, if you're coming over and providing personal services as a registered sole trader, as we would call it in Ireland, I think you would be okay from the date in which you come into Ireland. So if you come into Ireland early in the year and you are a resident in Ireland, I think it would only be from the day you come into Ireland. My reason I'm thinking on that is because prior to that, when you're in America or wherever it is that you are, it's classed as foreign income. And assuming you're coming to Ireland and you're not an Irish national in the first instance, you'll qualify for the remittance basis of taxation. So unless you're going to be remitting that money that you've earned prior to arrival in Ireland, I think you would be okay. But as I say, for even relatively modest levels of income, around the 40K or 45K mark, we would advocate that you're probably better off having a company structure. And if you had a company structure, you'd become an employee of that company, and you would only be, you could potentially look at split year relief as well, where you only elect to be resident in Ireland from the date of your arrival, and you're only taxable in Ireland on your employment income from that date. So they would be the options as I would see it with that.
Okay, wonderful. Hope that answers your question. If not, let us know. Moving on, the next question. So this person is not a sole proprietor, or an independent contractor. This person is an employee. And I guess because I get this question a lot, I'm sure you do as well, Damien, because, a lot of, especially the technology companies, they are extending apparently indefinitely the remote work policy. So you don't really need to return to the office anymore. So some people are working from different states and different countries as well. So this person is a full-time employee for an American employer, and they decide to relocate to Ireland and work remotely from Ireland, but they're an employee. What consequences would that be for the income that they earn? And I'm sure you've touched on this in the deck that you already gone through.
So my take on that would be,
But just secondly, just to add to that part, is there any risk to the employer back in the US as well? Over to you.
Yeah, I think the employer would have employer obligations in Ireland. So if the person is going to be living and working in Ireland indefinitely, I think the US employer, the foreign employer, would have to register in Ireland and operate an Irish payroll on their salary. And that's all it is. And it's quite common. We would have quite a significant volume of payroll clients that would fall into that category. And it's fairly straightforward. You get the foreign employer a tax reference number in Ireland and then just operate a payroll on that. Just from a legal perspective, not quite sure from a legal side, is it Irish employment law or is it US employment law on that one? And that would be something to keep in mind as well on it too. Yeah.
Right. And I just want to add in, as you mentioned that now, is there any risk at least from the Irish Tax Authority of this US company having permanent establishment or having a taxable presence in Ireland? I think it would depend on what the person is actually doing. I think like if it's just a person employed in a function of the business, I don't think there's any risk of a PE there. If the person has, let's say, the ability and authority to conclude contracts and that sort of thing, I think there is potential scope there in the double tax treaty where in that scenario potentially yes, a PE could exist. But generally, if they're just performing a general admin, sales, R&D, whatever the function is, there shouldn't be any concern for the foreign paymaster. Wonderful. So I'm going to skip the question after that because I think Damien answered that as well. 5 months. Okay. Another one from the sole proprietor or the independent contractor. So what if they work in Ireland remotely for that as an independent contractor, not as an employee? This is a previous person now. And they work for 5 months, so they don't trigger 183 days or anything like that. They just work remotely for 5 months and then they leave. Are there any tax ramifications to that?
I think it would be very difficult for the Irish tax office in Ireland if that was to tie them down. And technically, I suppose it is Irish source income, but they're not going to be resident here. They're not going to be resident here anyway. So I think they'd be safe enough with that one.
Yeah. So, but they, I mean, it's hard for anybody to figure it out, but would the correct thing be for them to voluntarily walk themselves down?
I think it depends on what their intention was on day one.
Right.
If their intention was on day one that they were only going to be there for less than the residence, less than their resident requirement, I'm not sure. I don't think they would have a registration requirement in that regard. But if they were coming to Ireland and let's say they'd signed a lease and the lease indicated that they were going to rent somewhere for a year, I think they would have to register in Ireland then, and I think they would have to pay their tax accordingly on that. So I think the intention of the person would be an important factor in that scenario. If they're strategically moving around and ducking and diving, yes, they could be. I'm sure if the tax authorities catch up on them, they might have some difficult questions to answer. Put it that way.
Okay, understood. And on that theme of mobility, right? If I were to acquire a Caribbean passport, which I guess they can be purchased, citizenship by investment, right? And I were to leave both Ireland and the US, would I be able to live tax-free? I'll answer that from a US perspective. From a US perspective, as I mentioned earlier, the answer is going to be no, because as long as you hold on to that US passport or US green card, then you will be subject to taxes in your worldwide income regardless of where you reside. So it makes no difference where you go. It makes no difference where you go. The only way around that is, in addition to acquiring this Caribbean passport that you're talking about, you would also need to relinquish your US passport and or green card if that applies to you. What about from an Irish perspective?
From an Irish perspective, it depends on whether they're an Irish person or a non-Irish person. If they're a non-Irish person and they go and cease being resident in Ireland and take up residence in the Caribbean, they're safe enough. If they're an Irish, assuming that they've no Irish source income, of course, if they've Irish source income such as rents or something like that, or I see one of the comments there about having a holiday home. If it was a holiday home in Ireland and there was rent coming in on that or whatever, or they'd have to pay tax in Ireland on that. But that should be the extent of what they would be caught in Ireland for as regards their total worldwide income.
Okay. All right. Hope that helps. This person I'm moving to another set of questions now. I am a US citizen. My partner is Irish. We file Irish taxes, but I haven't filed US taxes since 2016. My partner is self-employed. I receive X amount from business to make my PRSI contributions. Do I need to file US taxes? So you'd need to really speak to an advisor who'll know your situation inside out, because it's so different. There's so many different categories of income. But generally speaking, just generally speaking, if you, for example, file married separately, which may be the case if you are married to a non-US person, you would file as married, filing separately. The threshold is actually $5. The filing threshold is $5. So if you've made more than $5 for the year, then a tax return is due. Now, of course, taxes may not be payable to the US because generally speaking, taxes in Ireland may be higher than in the US, but a tax return may still be due. And in that tax return, there's a calculation of taxes payable, if any, but there's also an asset declaration. So you'd need to declare bank accounts that you may have in Ireland, or maybe even pension plan, personal or whatever your pension plans may be, or investment plans. You may have investment structures or whatever. So there's the tax calculation, but there's also the asset declaration to keep in mind. Now, if you have not filed for a while, there is a way of playing catch up. There's a program that's an Amnesty program for the US, and it's Amnesty in all but name. It's called the Streamline Compliance Procedure. So what it requires you to do is just file the last 3 years which due date has already passed. So in this case, right now, we'd be talking at the time of filming this, it'll be 2020, 19, and 18. And so even though you may not have filed for a year before that, that's okay, because the statute of limitations says to look back is only 3 years. So you file the last 3 years, and the IRS agrees to turn a blind eye to the income that you may have earned before that. And you would, of course, pay the taxes due, if any, together with interest. But more importantly, you would legally avoid civil and criminal penalties that may apply. So it's a really, really, really good deal. So I encourage you to speak to ourselves or whoever your chosen tax team is about the streamlined compliance procedure. So hope that helps. Moving down the list of questions that we have here. How is a holiday home taxed? And I asked, where is it? Okay, so if it's a holiday home and it's being rented out when you're not enjoying it, of course, from a US perspective, of course, the US is going to tax you your worldwide income regardless of where the income is derived or where you are. So that holiday home will be subject to US tax reporting and tax calculations. Damien?
Yeah, so if you have a Irish holiday home and you rent it out, you're always going to pay tax in Ireland on the rent. You will also have to pay your local property tax. So depending on where the holiday home is, the rates of the local property tax have gone up in the last, well, they're going up from next year actually. So it wasn't so bad up until now, but there is a bit of a jump in it, and so it depends on the value of the property. If it's if it's a couple of $100,000, it's generally a couple of €100 a year. But as you get closer up to the mill and as you go beyond the mill, it is quite a burden on a property. So keep that in mind. You file an annual return to pay the tax on your rent in Ireland, and that's how it works. If you have a letting agent, in situ managing the rents for you, they will generally withhold 20% of the gross rents, as they're obliged to do. And the tenants are supposed to withhold 20% as well, but very few tenants would be aware of that obligation. Up until once your level of rental profit that you make from letting out Irish property doesn't go above 35,000 a year, you're not going to be taxed any more than 20 something odd percent on that. But if it does go above 35,000, you will jump up to 40 something percent on the balance thereafter. So that would be for investors, and there are quite a few international investors that would own multiple properties in Ireland. So the tax is quite high on it.
Okay, thank you for that. Moving on to the next question that we received. If you receive an inheritance from someone in the US, how is this going to be taxed? So from a US perspective, it's pretty easy, because in the US, we have estate taxes, and they're levied on the estate. So this is the responsibility of whoever's managing the assets of the person who has passed away. They're responsible for estate taxes. Someone who is receiving doesn't normally pay any inheritance tax. Now, there are some exceptions at the state level, but at the federal level, no. And I'm assuming that you are in Ireland, so the state issues won't apply. So that answers it from the US point of view. What about Ireland, Damien?
So in Ireland, if you're a US person that has been living in Ireland, you would have to be living in Ireland for more than 5 years and resident here for capital acquisitions tax to apply. So if you've only moved to Ireland within the last 5 years, you should be okay. Assuming there's no Irish situate assets, and assuming that the person who passed away is a US citizen themselves, you would be out of the tax net. Just to point out, the capital acquisitions tax in Ireland, how that works is we've 3 different categories. So we've category A, B, and C, depending on your relationship with the person who has either passed away in the case of inheritance, or who's gifted, who has made you a gift. That determines the threshold and the group that you fall into, and each group has a tax-free threshold essentially. So you don't pay tax until you receive a gift or inheritance above that level in your category. That's how it works in Ireland.
Okay, understood. So just to be clear, the tax is the responsibility of the person receiving it, not the person.
In Ireland, if they're in receipt of it, yes.
Gotcha. Thank you for that. All right, moving on to the next question. Can you work remotely if you own a holiday home without triggering the Irish income tax, as long as you don't stay longer than 5 months in your holiday home in Ireland? Damien?
So remember, it's 5 months in 1 year, but if you spend 5 months in 2020 and 5 months in 2021, you are going to be resident in Ireland by virtue of the look back. So always watch for that. But if you were to reword the question a different way, and if you said you're only going to spend 3 months in your holiday home in Ireland in both years, then technically you're not going to be tax resident in Ireland. My only sort of the final, I suppose, hurdle for you to jump on that was, that's assuming you are tax resident somewhere else and you're not actually a resident anywhere. And in an unlikely scenario where the Irish tax authorities got wind of that or got visibility on it and took a case against you to deem you tax resident in Ireland, by virtue of Ireland being your centre of vital and economic interests and all of that, and by having this holiday home available to you for 3 months of the year. So that would be my only proviso on that. But no, generally, if you manage your days and keep a good log of your days and you are tax resident elsewhere, you shouldn't have any problem in that regard.
Okay, so just to be clear, as long as they do not pass 3 months over 24
well,
months.
It's actually a little bit more. So it's 140 days each year on average, and you could do 150 days 1 year and 129 days the next year, or vice versa, and you would be okay. So it's 280 days between the 2 years. But as the question was asked, on 5 months, you would actually be slightly over. So I think maybe 4 months, you're probably okay as well. I used 3, but you're probably okay with 4 as well.
Okay, wonderful. Thank you very much for that. So for those who want to follow up with Damien, what's the best ways that someone can find you?
Find me on email, damien@maloneaccountants.ie. On LinkedIn, you'll find my profile if you Google my name. You can follow our social media channels and all that as well, between Facebook and Twitter and whatnot, and of course by good old email as well. So more than happy to respond to any email inquiries that you have if anyone didn't want to ask a question on the chat.
Fantastic. And for those who want to share this, this will be available for viewing on HTJ.tax as well as on YouTube. And for those who prefer podcasts, we are available wherever you find your favorite podcasts. We're on iTunes, SoundCloud, Spotify, Amazon, basically wherever you find your favorite podcast, you can find us there as well. Thank you for joining us. See you next time. Bye-bye.
Here are 4 ways we can help you. Number 1, sign up for free webinars on US expat taxes and international entrepreneur taxes at www.htj.tax. Number 2, stream premium educational videos at www.htj.tax. Number 3, contact us for tax optimization consult over Zoom. Number 4, high net worth. We can quote for doing your US international taxes returns. Our books and upcoming event are available at htj.tax. Please subscribe, like, share, and comment below. Email us at help@htj.tax to engage us, to advise on international tax or business matters.